Good morning, everyone. It's pretty exciting to be here and see so many of you very keen to know how this landscape of alternates are evolving. When Prem had approached me that I should be talking, so I thought, okay, fine, let me try and build a perspective on how the landscape of alternates are building it up. And that is what my topic for today, which is to think beyond listed equities. Now, when we see it, alternate funds are by all means a very big growth engine, and I'm using the word globally. If you try and draw a parlance between how the things are evolving globally and how is it happening in India, you would see that alternates are actually a very, very big asset class globally. India is evolving, and today we are talking about how are we unlocking all of this. Look at it, how the things have shaped up globally, right from 05 to 021. If I would look at a journey of 16 odd years, the growth on the assets per se has been close to 6 odd percent. But then a significant shift came in between 022 to 023 when the growth rate practically doubled. And that's where the people started noticing more of trend building it up globally. If I see the AUM split, in 05, as you could see, alternates were holding 11 odd percentage, and largely the assets were with actives. As we go further, that number of 71 came to 16, but what is very important to notice is the number of 11 has started graduating, and that number has gone to 15. If I go further, 15 becomes 18, and keep an eye when the numbers are increasing, it is all happening at a cost of actives making a way. And if I look at 026, which is an estimated number, our view is that alternate on a base of 149 trillion USD, which is the asset base, they should be close to 19 odd percentage. And active, right from a 71%, actually have come down to 41. So that's interesting phenomenon that you could see. Two spaces are making inroads. One is alternates, and the other one is passive. If I look at India, globally, if you see, the active management doesn't just hold 48% of the universe, but in India, it is almost 67. India still is a great alpha market. But the important point to note is, alternatives, while it's holding 17% globally, India just has 12 odd percentage to talk about. Prem, if you can have more people move in, because this is more for the people to understand. Otherwise, it's just not making sense here. If I look at further, because these are very important statistics for you all to understand what is the size of opportunity which is evolving. And hence I requested people to move in because they should be able to understand it. If I look at a public market, the growth, it has been 5.5 CAGR. But look at, on the contrary, how the growth has been on the alternate side. Again, 2x. And believe you me, all of it that I'm talking right now are the global phenomena, because now we will move into India to understand how the India is evolving, because for us to understand India, it's very important to understand the context, which is what we are trying to build globally. And that's where I'm coming to India now. How is it India doing? Let's look at a mutual fund. All of us understand this space pretty well. Doing well, growth rate being 17 odd percentage. I'm talking about a great journey of close to a decade. 17% of a growth over a decade look pretty exciting. Look at a PMS. Again, a great journey. Instead of a 17%, the growth is close to what? 13.5. Now, few of you may say, Anunaya, the base could be the reason for all of it. But the reality is, if I look at an alternates, and I'm talking about a fund raised, I'm not talking about the commitments, actually the fund that has got raised, that number is phenomenal, more than 50%. So the growth rate, which is what the traditionals largely being at 17%, is almost 3x as we go towards alternates as the fund raised. So that's a very important journey for one to look at, how the industry in India is evolving. Besides, if I look at further, the very distinct phenomenon got noticed within India as well. If I look at a Cat 2 and a Cat 3, the growth of a Cat 2 has been far and more promising and encouraging if we compare it with the growth of a Cat 3. And if you see the fund raised and a share of AUM, what you could see is a 76% in 014 was an alternate share of a Cat 2. That 76 actually has gone to 80%. So Cat 2 is getting far and more mind share than what the, within the, if I have to say, alternate space, the way things are building it up. So that's one phenomenon that we have noticed. Now, two parts very, very predominantly gets into our mind when we talk about the category 2 sides. One is a private credit and a private equity. We'll do a little bit of deep dive into them to understand how is this space evolving further. Let's look at a private credit. The reason for a private credit to see a massive push is obviously a funding winter that everybody would have noticed. There was a time when the people weren't ready to commit the money to the startups, and hence the natural need, the natural appetite for a private equity started getting built up, and that's where the people started noticing coming in. Taxation law changes, we all know what has happened in the debt taxation. That has obviously been a huge fillip for someone to start considering private element to raise the money, private side. The people who are more of an yield-seeking investors, they see private credit is a better, because the performing credit obviously gets you a far better yield than what you would be able to get through a traditional approaches. And obviously, the balance sheets have become far better. The NPA levels have started coming down, and all of this obviously further started contributing to a good credit boom in India. But these are the key drivers. What is important is to see how the industry has evolved. If I look at the industry of alternates being $80 billion, see the change. I'm talking about change in 05 to 022. The private credit, what used to be 17%, what used to be 2% in 05, actually has grown to 17%, almost 8x. Now, this is the way things are building up. And while this is history, this is historical, if I look at the statement forward-looking, then I would talk about this market. Performing private credit itself is a $96 billion market. And within the $96 billion, they are growing at 12%, which practically would mean, I'm talking about a $10 to $23 billion getting added, which is a potential opportunity for one to tap in a private credit side. The market has really grown and has demonstrated a growth of more than an 8x in last 15 to 17 odd years. But forward looking, if I see, there is a massive opportunity to tap as we go further. Reasons, very simple. Broadly, if I can think of, one is the supply side, one on the demand side. Supply side, if I talk about, the shift among the bankers. They're getting far and more retail orientation that they are taking. The retail orientation, what it has done is, you see the books of the corporate books are declining massively. If I see the AUMs of the credit mutual funds, they have declined massively. And that space, which is getting created because of supply constraints, is where you could see performing credit or a private credit kind of a people are making the move in. So this is more on a supply side. If I go to the demand side, and this is largely coming to how do I see the balance sheets getting better. Balance sheets are becoming far more encouraging. The element of debt or the debt components are coming down, and that, if it gets coupled with your capacity utilization getting closer to 80, which practically tells you, look, I don't have a choice. And what do I mean by I don't have a choice? Now here, who is I? I is an entrepreneur. entrepreneur, the moment it goes beyond 75, will have to put his thoughts together to look for a capex, because capex itself has a lead period time of 2 to 3 years. So what he would do, his balance sheets are looking better, his debt element has come down, he has a pressing need to go for a capex. It's a great opportunity for one to consider raising money, and that's where the demand gets created. And that is where one of the demands. So supply is getting lower, demand is seeing a fill-up, and that is where we see private credit is making a lot of sense. We have done one element. Now we will move to the second one, which is the private equity. Key drivers, I think I don't have to really speak too much about it, because we all know what kind of opportunity India is building up, is on delivery, giving it to people. If I talk about the digitalization, it's massive. Whether you talk about the penetration or you talk about the cost of using the data, both of it is helping making a massive UPIs, and all of it is creating an opportunity for someone to look at private equity. This is a very, very significant point. For someone to commit money with a 7, 8, 10 years of a time horizon, the very basic that a guy would look at is the political stability. That stability has further been a very strong reason as a catalyst for a story on a private equity getting built up. Now this fellow, this country, the China, had always been a pretty dominant hub for the manufacturing and a supply base. Their declining or their opaque approach on various decisions and an approach obviously has been one of the very strong reasons for India to feel good about. And the most important, see, private equity or a private credit, please understand one fact. The fact is, besides the risk that you carry on an asset, there is an inherent risk, which is the liquidity risk. Practically, there's no liquidity. You have to find an exit. Now, the good part of the private equity, with the buoyancy that we have seen in the capital market and the way the capital markets have started emerging, there are natural exits both through an IPO or outside the domain of an IPO between the private equity players or the retail part or the ultra HNIs contributing to building an exits. So that has been a strong reason for people to start believing in private equity as well. And all of this has led to what? Has led to India, which in 2018, if I talk about, holding 15% of the APAC PE business, that 15 has gone to 20 if I look at the journey of last 5 odd years. So opportunity is getting better, bigger, and the beauty is India is started showing his dominance in terms of capitalizing on those opportunities. And all of this is largely because of the points I have kind of alluded when I was, referring to the previous slide. But when we talk about the equity, this is important. This is important, why? Because if I look at the journey and put it into 3 stages, early growth and obviously COVID changed the dynamics significantly. So while these numbers are the numbers, but the pointer is somewhere else. The point that I'm trying to make is, what was a $20 billion annual opportunity to get tapped, the 20 has become 40. If you see, as we have progressed further, the baseline has moved from a 20 to 40, and that is a bigger point that I'm trying to make. And when all of it has happened with a very different perspective. The perspective is, if I look at among the better economies, China obviously had a different reason, so let's not go too deep on a China. All of it has happened with just 2% penetrated to our GDP. Globally, the world is between 3 to 5. So practically I can double. Practically I can double with my GDP contribution getting bigger. So when we spoke about that 20, the new rule of a 20 is a 40 today, the 40 itself comes up with a minuscule penetration. And that leaves a huge opportunity for one to consider, which is the reason we all are sitting in this room with an understanding that alternate space as an opportunity is really going to go super big. Look at MOICs. MOIC is nothing but a multiple that you would get on your invested capital. So if I look at an MOICs, average holding period, if you see, is between 4.5 to 5 odd years, if I look at across these sectors. But look at your multiples, 3.2. With a holding period of 4.5 years, across these sectors, the MOIC that I would look at, your average is close to 3.2. And if you have been lucky, having into consumer technology or an IT-enabled services, the numbers were even better, close to 5.5. Good exits, rewarding exits, and a massive opportunity. This is what this is all signifying. Conclusion. So we have understood pretty well that globally things are looking very exciting. It's growing at 12.5% compounding. India is just a small portion of the global story. What is happening in global, Parina, I can tell you it's a matter of 5 to 7 odd years. It's all going to happen in India as well. Private credit, private equity looks pretty exciting, but where are we? I would want to skip because I want to talk on this slide here. So assuming in 21, we are at 50 lakh crores. Okay, and if I look at a 50 lakh crores breakup, alternatives are 12%. Active, India has always been an alpha market. Active will have a dominant role. 67 to 70% is active. Your solutions are 10 and a 10 is passive. But if I see the journey from here on, which is what we all are excited to understand, we are talking about what 2026 estimated the numbers, or in FY27, we feel the industry actually is going to double from here, and 50 is going to be 100, which is the new norm. But when the journey of a 50 to 100 will happen, that journey, the nature of the journey would be very, very different than what we all had seen in the past. Here, the growth of alternates is going to be 24 odd percentage, and talking about an allocation or representation moving in from 12 to 19, and most of it, if you see, are coming at a cost of active. So solutions are seemingly looking better. Your passives are going to be the time to, for an opportunity to capitalize, but alternates are going to take a lion's share, talking about growing at almost 24 odd percentage. So this is the conclusion that we feel. That's it from our side. Thank you for being a patient listener. Thank you.